Hello everyone. Thanks for staying tuned to Investopick platform, and thanks for supporting me. Thanks for your love, and keep supporting me this way. So by the way, this is just an update video which I am coming up with today. So by the way, today in this video, I'm going to be talking about the GDP data which has been rolled out by a government recently in yesterday only, and I'm going to be talking about what is the state of the Indian economy and what the GDP numbers are telling to the market and how it is weighing on the Indian economy. So first of all, I'm going to be talking about the GDP numbers, and then I'll be talking about the GVA numbers. Then I'll talk about the investment activity, the construction activity, and the IIP data, which we call the high frequency numbers. How all these things are looking and how all these things are weighing on the Indian economy. So let me start with saying that the market is not gloomy right now, but if you go to see the economy, the Indian economy, it is on a gloomy stage. People are saying, are we heading for recession? I don't think so we are heading for recession, but the high frequency data and the proxy indicators and the leading indicators seems to suggest us that we are going through a lot of pain points. And right now we are as I have also mentioned all these things. So basically we have seen a broad-based deceleration in the market, and we have been witnessing deceleration onto many fronts, be it manufacturing, be it electric, be it let's say coal. It could be anything. We are witnessing a broad-based and a what do we call it, the synchronized slowdown. As it was said by Geeta Gopinath, that right now India is going through a synchronized slowdown, and we want some sort of fiscal policy stimulus, monetary policy stimulus. So this is a different story altogether with respect to the global GDP outlook, with respect to the state of the Indian economy. But today in this video, I am going to be talking about the GDP numbers and how all these things are telling us that what India is doing right now and where India exactly is standing at the moment. So basically the data which has come, which seems to suggest us that the GDP growth for the June-September quarter has come to 4.5%, which is at 6-year low. I would say, this is one of the biggest tanking which we have ever seen over the last 6 years. And at the same time, if you go to see the cumulative, if you go to see GDP in a cumulative manner, it is standing at 4.3% for the first half of FY20. And if you go to compare this particular GDP outlook with respect to the previous year, so right now it is at 4.3%, and comparing with the previous year, it was 7.5%. So this is one of the biggest tanking which we have been witnessing on the GDP front outlooks. At the same time, if you also go to see the GVA numbers, that has also decelerated on a masses level. So GVA numbers are standing around 6%, and the nominal GDP growth rate for the quarter gone by is standing at 6.1%. So nominal GDP is at 6.1%, and the core GDP is at 4.5%. I would say these things are not looking as great as we were thinking of it to be. Now let me move on to the investment activity. Investment activity has also subdued a lot, and so basically if you want to see how investment activity is shaping up, then you should see the GFCF numbers, that is nothing but the gross fixed capital formation. So if you go to see, we were growing at 8% in FY19 first quarter, then we turned down to 7%, then we came down to 6.6% in Q3 of FY19, and right now we are at 4.5% with regards to GDP. And in the previous quarter, the FY20 quarter 1, at that point in time our GDP growth rate was pegged at 5%. At the same time, I would also like to tell you that the contraction in the core sector has been very broad based, and it has been standing at 5.8%, and this is a successive continuation of the second contraction which is happening on the core sector front, which makes up of 40% of the IIP numbers, that is nothing but the index of production activity. If you go to see the fiscal deficit target, that has also breached the FY20 the second half of the target. So right now the fiscal deficit was pegged at 7.2 lakhs crore, which is 2% above than the the second half of the FY20 target. At the same time, the consumer demand have also seen some sort of pain points, and it has also slowed down, which is in turn weighing on the Indian economy, and that is in turn on against that backdrop, that is also impacting the GDP by and large. IIP has also been trending lower, and as I've said, core sector makes up of 40% of the total IIP, which is also an important data to watch out for. At the same time, GFCF, as I was talking about, the investment activity has also seen some sort of tanking, have seen some sort of deceleration, which has also wagged on the GDP numbers, and right now it's quoting around sub 10%, and in the previous year, if you go to see, it was more than 20%. So this gives you a sense that people are not investing in India, which in turn gives you a sense, and it gives you a sense that people are not as rosy as people used to be in the last years or over the last 3 to 4 years. At the same time, if you go to see the credit rating companies, if you go to see Fitch, if you go to see Moody's, these credit rating agencies have also pegged down the fiscal deficit target. So basically these companies have increased the fiscal deficit target for India from the government target, which is 3.3%, to 3.6%, which is pegged down by the Fitch company, which is a rating agency company, and Moody's have pegged the fiscal deficit target for FY20 to the tune of 3.7%. At the same time, people are saying, will India recover from this particular drawdown which is taking place, and is this a peculiar slowdown which is happening in the country, or it is broad based? As I'm telling you, and as data seems to suggest us, that it is a broad based slowdown, and by the way, this GDP numbers comes in a 2 months lag. So this GDP numbers is for the June and September quarter. After that, we had a lot of festivals, and we had good data coming from the automobile sector. We had good data coming from the electronic sector. So by and large, if you go to see, we have mining, which has grown at 0.1%, which is showing good signs, because it grew at minus 2.2% in FY19, and now it has grown at 0.1% in FY20, in the first half of the FY20. At the same time, manufacturing has seen one of the biggest deceleration. So manufacturing was growing at 6.9% in FY19, and now it is growing, it has grown at minus 1.0%. Construction activity has also given us the negative output, and this has also seen some sort of deceleration, and it is also weighing on. So basically, it was 8.5% in FY19, and now it has come at 3.3% for FY20. All these things are suggesting us that we are in a gloomy phase. And let me also tell you that the private consumption, which was at 9.8% in FY19, now it has come back and it has come down, and it has been dragged down very drastically at 5.1%, which is also a biggest worrisome pain point which India is suffering through. I would say, India as a whole, across the board is going through a turbulent phase, which is a worrisome sign. And we are we are getting a lot of alarm signs from the core sector, from the IIP numbers, from the high frequency numbers, and from the fiscal deficit numbers as well. So this was about the investment activity, the construction activity, the GBA numbers, the GDP numbers. Now let me tell you the the contraction which has happened in the core sector. So let me split into the total 8 core industries of core sector. So if you go to see coal output for the recent quarter, which has seen tanking of 7.6%, which is one of the biggest drawdown over the last 10 years. And electricity generation has seen 12% of deceleration. Cement has seen 7.7%, minus 7.7% of deceleration. Out of this core sector output, which comprises of total 8 core sectors, out of these 8 core sectors, only 2 sectors have done well, that is fertilizer production and the refinery product growth rate, which is standing at 0.4%, and fertilizer production stood at 11.8%. Now let me tell you where are we headed right now. I feel the RBI has also given the dividend to the government to the tune of more than 1 lakh crore, which has also supported the government on a positive side. So that is why we haven't got that sort of alarming fiscal deficit numbers. So though it is 3.6%, but it is not that alarming. Why? Because we had got non-tax revenue from central bank. We have got non-tax revenue from the RBI, which was transferred by central bank to the government. So all in all, what I feel that this data comes in the 2 months lag. So I feel the next quarter is going to be good, and let me tell you, the whole global market is growing at the 3.8%. It was growing at 3.8% in FY18, FY17. Now it has been dragged down to 3.2%. And at the same time, if you go to see, the developed countries are growing at 2%, and the emerging market is growing at 3.8%. India is still far better than the Vietnam. India is far better than the few high growth emerging markets, which indicates us that India is still attractive the country to park anyone's money in. And at the same time, if you also look at the FII data in the last month, that has also been very surprising, and that has come very positive, which is helping the market on a higher scale. So all in all, I would say, though India has been scaled down at 4.5%, but still India is far better than what the emerging market is doing, and still India is far better than where the world market is standing right now. So this was it, and I just wanted to give you this particular update. So you people are aware that where are we headed right now, and where are we standing with respect to the high frequency numbers and the overall outlook of the economy. So that's all. Thanks for tuning into Investopick, and stay tuned. And basically, after a few days, I'm gonna be coming. I'm going to be coming online, and I'll be discussing about a few stocks on only on Saturday. So till then, stay tuned, and thank you so much for staying tuned, and thank you so much for your love, and keep supporting me.